Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, the Guardian and the Challenger go head-to-head on 4.68% guaranteed versus market roulette. Why cautious savers should fill their cash I.S.A. First, let's get into it.
The best easy access cash I.S.A. pays for 0.68% tax-free right now. No fees, no platform charges, no stomach-churning drawdowns. For cautious savers, that's not settling, that's winning.
Winning. £20,000 in that cash I.S.A. earns you £936 a year. The same money in a FTSE 100 tracker earned £4,700 including dividends in 2025. That's 5 times the return, also tax-free.
You're cherry-picking one good year. The FTSE 100 dropped 20% in 2020. How many cautious savers would have panic sold at the bottom and locked in those losses?
And if they'd held on, they'd have recovered within 18 months. The real risk isn't short-term volatility, it's spending 30 years in cash and retiring with half the pot you could have had.
That compound growth argument assumes people have 30 years. A 55-year-old saving for retirement doesn't have the luxury of waiting 18 months for a recovery.
Fair, but even a 55-year-old likely has a 10-year horizon before they fully draw down. And nobody's saying put everything in equities, even a 60-40th split massively outperforms pure cash over a decade.
You're also ignoring that 4.68% sits above the Bank of England's 2.1% inflation forecast for mid-2026. That's a real return of over 2.5% with zero risk. When did equities last offer guaranteed real returns?
Never, because nothing in investing is guaranteed. But here's what is guaranteed: cash I.S.A. rates are falling. The base rate is 3.75% and heading lower. That 4.68% is a teaser, not a permanent fixture.
Which is exactly why I say fill your cash I.S.A. now, while this window is open. Lock in these rates before they drop.
But you can't lock in an easy access rate, it moves with the market. And even if you fix for a year, what happens next year when it's 3.5%? You're back to barely beating inflation.
And what happens to your stocks and shares I.S.A. when the next correction hits? At least my 3.5% is still 3.5%. Your portfolio could be down 15%.
Over any 20-year period in FTSE history, equities have beaten cash. Every single one. The longer you hold, the more certain the outperformance becomes.
But cautious savers aren't robots. They feel losses twice as sharply as gains. That's basic behavioral economics. The best investment is the one you can actually stick with.
I completely agree with that. Which is why I'd say start with a global tracker, automate your contributions, and stop checking the price. The automation removes the emotion.
You're describing an ideal investor who doesn't exist. Real people check their apps daily and sell when markets tank. FSCS protection up to £85,000 means my cash I.S.A. money is genuinely safe, no discipline required.
FSCS protects you from your bank collapsing, not from inflation eating your savings. If inflation averages 3% and your cash earns 2.5% after rates fall, you're losing purchasing power every single year. That's not safety, it's a slow bleed.
Right now, today, I'm beating inflation by 2.5 percentage points with zero risk. You're asking cautious savers to gamble on the hope that equities will do what they've done historically.
It's not a gamble, it's a probability backed by over a century of data. And the tax advantage in both wrappers is identical, so you're giving up growth for no additional tax benefit.
The flexibility benefit is real though. I can withdraw from my cash I.S.A. tomorrow with no penalty and no worrying about whether I'm selling at a loss.
Most stocks and shares I.S.A.s let you withdraw whenever you want to. Yes, you might sell at a temporary low, but if you're investing money you don't need for 5+ years, that shouldn't matter.
Should and does are different words. People lose jobs, need new boilers, face emergencies. Cash is there when life happens.
Then keep an emergency fund in cash, 3 to 6 months of expenses. But everything above that. Leaving it in a cash I.S.A. is the most expensive decision cautious savers make, and the finance industry keeps telling them it's prudent.
Or the finance industry keeps pushing people into investment products because that's where the fees are. Nobody earns a commission on a cash I.S.A.
That's a fair point about incentives. But a Vanguard FTSE Global All Cap charges 0.23% a year, that's £46 on 20 grand. The fee argument doesn't hold up against index funds.
It holds up when you add platform fees. And it definitely holds up when you factor in the emotional cost of watching your life savings drop by a fifth in a bad year.
The emotional cost of watching inflation quietly halve your savings over 20 years is worse, you just don't feel it happening. That's what makes it so dangerous.
We're going in circles. My final point is this: for genuinely cautious savers, 4.68% tax-free with FSCS protection and instant access is the best deal in a generation, and they should fill that I.S.A. before rates fall.
And mine is this: caution isn't about avoiding all risk, it's about avoiding unnecessary risk, and the biggest unnecessary risk a long-term saver can take is leaving their money in cash.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.